BSB Marketing, uh, I'm going to discuss the currency instrument that used in forward market. So, what is forward market? So, when we say forward market, is an over-the-counter marketplace that sets the price of financial instrument or assets for the future. When we say forward market, we usually have a physical delivery. Is an over-the-counter, uh, informal over-the-counter financial market by which contract for the future delivery are entered. So the first instrument and currency instrument that we use that we can use in forward market is currency swap. So the definition of currency swap based on the module is simultaneous buy and sell of a currency for two different dates. So when we say currency instrument is an agreement which two parties exchange a loan and interest. So for example, you have a US dollar and you want to exchange that into a Philippine peso. So for the purpose of currency swap is to hedge exposure to exchange rate risk or reduce the cost borrowing of currency of a foreign currency. So the second one is currency option. So when we say currency option based on the module is the option or the right but not the obligation to exchange specific amount of currency on a specific future date and a specific agree on rate. So since a currency option is a right but not a requirement, the parties is an option do not have to actually exchange the currency if they choose not to. So when we say currency option, it is provide an opportunity for investor to take view on exchange rate, and currency option is a derivative contract that gives or sell the currency at a stated date and price. The seller of the contract has the obligation and to honor contract when the contract is exercised. There are two types of currency option. One is to call and put. So a call, when we say call option gives the right to buy, and to put is an option gives the right to sell. So the last instrument in that we can use in forward market is currency future contract. Uh, Currency contract are a type of future contract to exchange a currency for another fixed exchange on a specific date in the future. So, on the other hand, typically referred to contract where two parties agree to exchange a specific quality or definitely an agreement that investor has the right to buy or sell an underlying currency at a fixed exchange rate. So that's it. Once again, I'm George Noiva and this is my topic. Thank you.
Good day everyone, this is Camille Birolana and I'm going to report and discuss about the international global capital markets. Under this topic, we will tackle about the capital markets, ways to access the global capital markets, its benefits, and its major components. Let's discuss first about the capital market. So, what is capital market? Capital market is basically a system in which people, companies, and governments with an excess of funds transfer those funds to people, companies, and governments that have shortage of funds. This transfer mechanism provides an efficient way for those who wish to borrow or invest money to do so. For example, every time someone takes out loan to buy a car or a house, they are accessing the capital markets. Capital markets carry out the desirable economic function of directing capital to productive uses. Let us now discuss the main ways that someone accesses the global capital markets. Actually, there are two main ways, which are the debt and equity. Debt is money that is borrowed and must be repaid, while equity is money that is invested in return for a percentage of ownership but is not guaranteed in terms of repayment. This is the important thing to remember. In essence, governments, businesses, and people that save some portion of their income invest their money in capital markets such as stocks and bonds with hope of receiving a future benefits. Basically, a higher rate of return means a higher risk. The financial officer hopes that over the long term of investment will yield greater returns than cash holdings or interest on a savings account. So let's come now to the benefits that are provided by the international capital markets. So global or international capital markets happens in the global sphere in which governments, companies, and people borrow and invest across national boundaries. This provides two benefits. First, higher returns and cheaper borrowing costs. These allow companies and governments to tap into foreign markets and access new sources of funds. Many domestic markets are too small or too costly for companies to borrow in. By using the international capital markets, companies, governments, and even individuals can borrow or invest in other countries for either higher rates or in return or lower borrowing costs. Second, diversifying risk. The international capital markets allow individual or companies and governments to access more opportunities in different countries to borrow or invest, which in return reduces risk. Let us now talk about the last subtopic, which is the major components of the international capital markets. There are two components. First is the international equity market. Second is the international bond market. International equity market, companies sell their stock in the equity market. International equity markets consist of all the stock traded outside the issuing company's home country. Many large global financial centers and issue stock in major markets to support local and regional operations. International bond markets. Bonds are the most common form of debt instrument, which is basically a loan from the holders to the issuer of the bond. This international bond market consists of all the bonds sold by an issuing company, government, or entity shares and dilute the ownership interest of existing shareholders prefer using bonds or debt to raise capital or the money.
Good morning everyone, my name is Christian Impistaño. My lesson for today is also regarding from Module 7 in which the impact of global capital market. Before I start, I would like to ask, do you think capital is important? Yes, it is, because without capital, we cannot buy a house, cars, land, or any assets. Even by creating a small business, we need an investment. We all know that every business starts from investment. The capital used to start a business is so-called venture capital, or also known as investment used in an early stage of growing business. And venture capitalists are also known as investors. They are the risk takers. They always grab the opportunity only to gain more profit. One of the unexpected expansion of global capital market is the expansion of international capital venture. And I have a question. If you are investors and you want to make your money grow, where do you want to invest? To the existed institution or business that you know that it has a net worth. For example, Jollibee. Jollibee is always looking for potential investors that can help them to make their money grow and also help the investors to gain profit, or to the started business or growing business that you can invest in low capital but you can receive a big return of investment. But this type of investment is risky than from natural investment because it's not passed through from proper method of investment. Kadalasan kasi ang mga investor ay nag-i-invest dun sa mga existed na mga institusyon or individual na alam nilang merong mataas na net worth, kung saan para masigurado nila na ang kanilang pera ay nasa mabuting kalagayan. But sa paglawak ng venture capital, dumami din yung mga investors na nag-i-invest dun sa mga papalago at nagsisimula pa lang ng mga institusyon, kung saan makaka-invest sila ng maliit pero makaka-receive sila ng return of investment na malaki. But this type of investment is risky from natural investment. Sabi ko nga kanina, it not pass through from natural method of investment. This type of investment is not a liquid. Ibig sabihin, hindi agad pagbibinta or maipagbibili sa pamamagitan ng global financial market. Sa ganitong mapanganib na method of investment, malaki ang nakukuhang return of investment ng mga investors doon sa mga institusyon kung saan nila ininvest yung kanilang pera. Especially, it can be double or triple, depends if the investors give another capital to the person who need the investment. The factors that investors whether invest or not invest to the young and growing business is so-called exit strategy, or how can investors liquidate their return of investment. Ito yung paraan kung paano makukuha ng mga investors yung mga return of investment nila mula sa mga institusyon or individual na kung saan sila nag-invest ng kanilang pera. That's why most of the time investors always ask on the question where, when, and how they can get their return of investment. That's why investors always look for the list of possible acquirers. The expansion of global capital market offers venture capitalists access to, first is new potential investors in their venture fund. The expansion of global capital market will help the venture capitalists to look for new potential investors that can help them to gain more profit. And second is a wider selection of firm in which to invest. Because of the expansion of global capital market, venture capitalists can choose wherever they want to invest because of the wider selection of firms. Third is more exit strategy, including initial public offering in other countries outside their home country. Third is, the last is the opportunity for their portfolio companies to merge or required by foreign firms. That's all for the